Nothing is more frustrating than seeing your stocks tank and you lose money on failed investments. In this video, I'll show you 3 strategies used by Warren Buffett's mentor, Benjamin Graham, to beat the market every year. Graham posted an annualized return of around 20% from 1936 to 1956. In 10 minutes, you'll know how to have the right mindset when investing, and you'll also know how Graham's number works, so you can invest based on numbers and facts rather than trends and hype. Now, if you want to be among the 10% smartest who watches the whole video till the end, I can promise you something very valuable. I'll go through an old-school formula used by Benjamin Graham that not many people know of today. This will definitely give you the upper hand when choosing the best stocks to invest in. The best thing is that these tactics are as relevant today as they were 90 years ago, and you can do this too. Alright, let's dive in. So the first strategy Benjamin Graham used to beat the market every year is more like a perspective, one you can adopt to help see through the murky waters of volatile prices and really outsmart the market. He called this Mr. Market. Instead of watching stock prices and becoming emotionally attached to the volatile swings, we should instead imagine it replaced by a wild, moody, and unstable little salesman by the name of Mr. Market. Mr. Market is a great salesman. He has convincing reasons ready at all times to get you to buy a stock when it's high or sell when it's low. He can be hard to ignore when he's essentially knocking at your front door. We don't want to listen to him each day. But there is a silver lining. Watching Mr. Market walk up to your door day after day can give you some insights into the nature of his sale methods. On some weeks, Mr. Market comes skipping happily down your street, yelling about how great Apple stock is doing and how you need to buy some from him right now before you miss your chance for profits. Well, the funny thing is, if you wait until next week, Mr. Market might drag his feet up to your door with quite a different attitude. He may inform you that the Apple stock has been sliding for a few days and may even discourage you from buying some. As you can see, Mr. Market is quite manic. He gets caught up in the motions of the market and dumps that same excitement and fear right onto your doorstep. Sound familiar? Now, our job as intelligent investors is to know how to take advantage of him. When he's knocking at your door and wants to sell stocks cheaply, it's time to buy. When he's manic and optimistic, we shouldn't buy anything. Maybe we could think about selling. Warren Buffett learned this same lesson from Benjamin Graham, and he often cites it during conferences and in his lessons and letters. Warren loves Mr. Market. His unpredictable volatility isn't inconvenient for the Oracle of Omaha. It's a chance to get a great price on his favorite stocks. Let's hear the concepts of Mr. Market in his own words.
Exists in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market, is averages 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell. And the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. It's a bigger advantage if this partner of yours is a heavy-drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin. But if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced.
Mr. Graham had another useful strategy for finding profitable stocks. He was a big believer in utilizing a company's price-to-earning ratio, otherwise known as P/E, and book value per share, abbreviated as BVPS. He claims that he had an equation that could provide an investor with a particular price range for knowing if a stock was worth buying. The formula was called the Graham number, and goes as follows. The square root of 22.5 times earnings per share times book value per share. Graham based the value of 22.5 on his belief that the price to earning ratio should not be over 15 times, and the book value per share should not be over 1.5 times. So he calculated that 15 times 1.5 equals 22.5 and stuck with it. All this comes together to equate a certain price that represents the maximum you should be willing to pay for the stock. He stuck by his thesis that you should only purchase stocks that are valued underneath the Graham number. This made him a very wealthy man. We would recommend you to do the same. Now, if you find it hard to calculate this number, you can do it easily by going to this calculator, link in the description below. So, if we take the Alphabet stock, we just plug the numbers into the calculator. To find the book value per share, you can go to stockrow.com, search for the stock and scroll down. And the EPS, you can find at Yahoo Finance. Now, based on this calculation, the Graham number for Alphabet is $968. This indicates that the current stock price is 118% overpriced, and Graham would have asked you to pass on that stock. The Graham number is a quick way to screen during your stock due diligence. Historically, it has performed reasonably well when there are cheap enough valuations that enough stocks make the cut, of course. However, the fateful warning applies. Sometimes stocks are cheap for a reason. Add it to your tool belt, but don't rely solely on it. I'll soon present the other old school formula that I teased about in the beginning, but to get the full understanding of the formula, you need to understand the concept of the margin of safety. This is a principle that every investor should live by if they want to turn consistent profits. Unfortunately, it's one of the hardest rules for excited investors to get a handle on. Warren Buffett famously analogized the margin of safety as driving across a bridge with a truck. Now, when you build a bridge, you insist that it can carry 20,000 pounds. But as a safety precaution, you only drive 10,000 pounds across it. You have a margin of safety. That same principle applies to investing. A margin of safety is a space between the intrinsic value of a stock and the price you actually buy it at. You should invest in such a way that you have room for it to fail without you losing money long term. You do this by buying a stock that is well cheaper than its true value. If you determine that a stock is worth $150, you only buy it if it's 30, 40, or 50% below that. So if you buy it at $75, your margin of safety is 50%. If a recession hits and the company loses 50% of its value, you haven't lost any money from a long-term point of view. The margin of safety is the principle that Benjamin Graham swore by, and it is a cornerstone of modern value investing. Waiting to pick up stocks until they are severely undervalued will give your entire portfolio much better odds of turning profits. This does require patience, as well as tuning out that pesky Mr. Market, but the payoff and downside risk is well worth it. Before we finish off with Graham's old school formula that may become extremely powerful when calculating the value of a stock, I will ask you for a favor. If you have learned anything from this video so far, please leave us a like and subscribe. This is the best way to support us so we can keep bringing you insightful content. Now, principles and rules are great for keeping you focused on the right strategies, but what about some cold hard numbers? Benjamin Graham had one particular equation that he frequently used to calculate the value of a stock. This will be helpful to anyone attempting to create a margin of safety for themselves. The formula is quite simple. It goes as follows. V equals EPS times 8.5 plus 2G. Let's break this down. V equals the intrinsic value of a company. EPS is the earnings per share of the last 12 months. 8.5 is the price per earnings ratio of a no-growth company. Finally, G represents the reasonably expected 7 to 10 year growth rate. So let me show you a quick example of how it's used. We'll once again turn to the Alphabet stock. So the first thing you want to check out is the earnings per share. It's very easy to find. It's on the first page of Yahoo Finance. And right now, that value is $110.58. Second, you'll look up the growth rate. If you go to the DCF section of Guru Focus, the past growth rate has been 19% over 10 years. We can assume that it will be less in the future, so we'll do 15%. Now, let's plug those numbers into the formula. V equals $110.58 times 8.5 plus 2 times 15. This gives you an intrinsic value of $4.257. So if we roll back to the margin of safety with the current value of 2.118, this gives you a margin of safety around 50%, which I would say is rather good. This way of doing research is old school, but still valid today. It will definitely give you a great advantage over investors who base their decisions on trends or hype. If you want to learn more about how the old school guys make money, you definitely don't want to miss this next video, where I unveil the portfolio of Warren Buffett's partner, Charlie Munger. The stocks we cover in that video could be your own ticket to financial freedom. See you next time.